Okay. I will call the meeting of the trustees of trust funds for Wednesday, October 26, 2022 to order. I'll take a roll call of trustees present.
Present.
Peter Weeks is present, and I am present, and we're waiting on trustee Levinson. We'll begin by approving the minutes of the September 15th meeting.
So move.
I'll second that. Any corrections or changes? Hearing none, I'll call the question. All in favor? I guess we have to take a roll call.
Yes.
Peter's yes, I'm yes. All right. So we're waiting for our friends from TDUL. So you got some checks?
I do. I have two. One is a scholarship check, and the other one is the check for the computer system, which I'm waiting for one more piece of it, but I've gotten two of the three pieces that are on its way. So,
Great.
okay.
Did they end up costing more or less than we had?
A little bit
anticipated?
more than, I came in at $200 more, but that's because we wanted the backup disc, and that
Right.
wasn't on the original quote. So that's the only difference.
Certainly a reasonable price.
Yeah. Thank you.
Late in the semester for that, or is that for the spring semester?
It'll go towards the spring semester, I'm sure. I'm sure that they already had to pay for the fall.
What else do you have?
Well, I did speak with Tom Kozakowski, I think I'm saying his name right,
Yep.
and he will be attending the next meeting
Right, right.
to discuss basically the Tom and McCann, but are there any others that you want me to cull through and see if there's anything else that might be applicable for the high school for the athletics to be able to use, or?
Any?
Well, that may be a good question for him.
Okay.
You
Okay.
know, there used to be but I think that went into futures. There used to be the athletic injury fund.
Yeah, we don't have that one anymore.
So,
All right.
So, as I recall, we did have a discussion about how this fund wasn't limited to traditional scholarships.
That is correct, and it's not set up technically as a scholarship fund.
Right.
It's set up with the other school funds, like the Clipper Band Fund and those funds, because it's not necessarily based on educational, and the high school's not going to determine it. It will be you that determines it.
Right.
Yep.
I wonder if we should have Susan Morrell review that clause and maybe come to next month's meeting to discuss, you know, what the city's position is on what we can allow that money to.
I'm gonna sound stupid. Who's Susan Morrell?
Oh, she's the city attorney.
Oh, Susan, of course. Yeah. Sorry, I'm just.
You know, we
Susan Morrell.
when we had Bob here last time, we were focused on the conditions that were contained in the release of the funds from the estate.
Right, based on the
Yeah.
on the estate, right?
Tom, maybe it'd be a good idea to send her a memo and ask her to get us in writing so that
Okay,
we have a chance to review it and think about it before the meeting. And
Right.
if she wants to come, that's fine, but
okay, no, that's a good idea. Could you deliver to her a copy of that? I mean, I'm sure it's up in her office somewhere, but just.
It is, but I can make sure
And
that
just
she gets
send,
copied.
tell her that I will be sending her an email or
Yes.
or a memo or something, and just say that this is different than the ordinary scholarships, particularly as
Well,
to,
yeah, but it's not a scholarship.
that's what I'm saying.
Yeah.
And because we don't have one of our standard scholarships agreements, so.
Yes.
I just think we ought to have a protocol in place before we start getting requests from people to disperse that.
Sure. I will do that.
That would be great.
Yep.
What else we got on our,
Yep. Yeah, I mean, not that much, really. I mean, things are just kind of chugging along. Everything else is, I mean, by the end of November, for the December meeting, I'll have the scholarship information so that you all can look at what we might want to, or what you want to
For next
distribute
year,
for June, so that the high school can have those amounts and know what they're working with. We'll have that. We'll have the first half of the monies to the city for Prescott Park for probably the December meeting as well. So, did you want, I know I still owe you the list that you had asked of the years that all the scholarships were put into place for Stephanie. Is there any follow-up that needs to be done with Stephanie that you want to do for the November meeting, or hold that off?
I'll let you know before that meeting. You could just give me that,
Yes,
you know,
the listing.
updated list.
Yes.
Then I'll try to work out something with her before I come back here.
Okay. Yep. Do that.
Did you happen to do the spreadsheet that you do on the TD Bank
Yes.
funds? Yeah.
Just in case. This is September's.
Great.
Are you all okay with me forwarding that quarterly newsletter from PACE? I just find some of it informative, so I didn't know if you want it or not, but they still send it to me.
Yeah,
If
no.
you don't, I won't, but,
No, I think it's always interesting.
Yeah.
okay.
Judy, this says 8:31.
Oh, I didn't fix the, sorry. Good catch, Peter. It is for 9:30, though. I didn't fix the chart. Apologies.
Hey, Dana.
Hey, Tom, I'm sorry. I'm having trouble here trying to sign in, so I didn't know what number to call.
Okay, hold on. Do you have that?
I just sent him I just resent the email to him. I don't know if he can log in that way, or,
Do you have access to your email right now, Dana?
Yeah, I do.
I just resent the link.
Yeah, about 5 minutes ago, Judy resent you the link.
Okay. Trustees, okay, I got it right here. Passcode. Join webinar. Keep getting Safari cannot open the page because address is keep getting the address is invalid sign. But let me switch to my computer. Hold on.
Okay, yeah.
Valerie. Steve's.
Would it be easier just to use voice on the phone?
Yeah, no, let's do that as a default if you can't get in. You probably want to be able to see the folks from TD if you can, right?
Right. All right, I'm going to put you on the speaker and just continue while I try to switch to the computer.
Okay, that's fine.
All right, can you hear me okay?
Yeah, we can hear you fine.
Okay, great. Thanks.
Judy, the top thing at the top there that says includes payout this month from investment funds.
Right, we didn't have any this month, so
Okay.
that's why there's nothing
So it's
there.
0.
It's 0. Yeah, and you had asked me to put zeros, thinking about it now, and I apologize. I will note that as well.
So the whole 1.4 million was all in a loss of value.
For this month, yes.
Yep.
I mean, for that month, yes.
Did you send these materials to Dana?
I did not. I will, though. Good luck.
Oh, boy. Now I'm in a hotel and it's not letting me connect to the internet because of security on this website.
Just as a reference, I was able to join on another computer, so the link is okay. It sounds like it's something on.
Okay, yeah. He's having sketchy internet service right now, so.
Which I would just say that he doesn't just want to stay on speakerphone point that microphone.
He's on my phone.
Yeah.
Is that bother you?
On there, I would just point this microphone at it, just
Okay.
for the sake of recording. Thank you.
Right. Wonder if Suzanne will have the same problem.
He said that he logged on from another computer just to make sure the link worked, and it did, so hopefully she'll be okay. She's probably logging in from either her office or home, so I would assume that that's secure. I think part of the reason Dana's having issues is because it might not be registering as a secure Wi-Fi connection. Hotels can be kind of funky.
Yeah. Oh. Nowhere. Connected. Okay. Let me try it one more time.
Where are you, Dana?
I'm in New York City. Charlie.
Good morning, gentlemen.
Where, John?
Don't know why I can't get on the internet. You want me to find out there? Yeah.
My printer thanks you.
Yes, you're welcome.
No, I haven't.
Can you open it for me?
We have technical difficulties here.
Dana has technical difficulties.
Do we have, Can we hear, we can hear him?
Yeah, he's on my
He's
phone
on
right now.
speaker.
He's on
right
your
now.
phone.
Yeah.
Oh, okay.
He's trying to log in and running into problems.
And how about Suzanne?
Haven't heard from her yet either.
Waiting for her. I don't
I
see
gotta go
her
in
yet.
this mine.
Okay. So I'm not holding us up.
No, you're not.
Where is Dana? And I think you mentioned Florida, but,
He's in New York right now.
oh, he's in New York, okay.
He's traveling.
So many folks were impacted by the hurricane. I didn't know if,
He's on the East Coast, I believe.
yeah, that helps.
Oh, come on.
Attendees
Give me the
1,
internet, the browser.
participants 3.
No, give me the internet, where you search Google.
Participants 3. That might be the computer he logged in on, though.
Where? Yeah.
Let's see.
Think you're gonna be able to hook in, Dana?
I'll know in 1 second.
Okay.
Can you all hear me now?
Hi, Suzanne.
Here we are. Hi.
Hi, Suzanne.
How are you?
Training.
Little drizzly here too.
One more day of this, I think, on our end.
Yeah, sun for the rest of the week.
Yeah.
It's
Better
the
than-
fall.
It's better than snow.
All right, paste this into you. I'm going to paste this into the browser. Launch meeting. Oh, I get the same thing. Let me go try one more thing. Oops.
Suzanne, we're kind of waiting for Dana to see if he can log in. He's having some IT issues.
Oh, gotcha. So do you have all the scarecrows on the street lamps?
Yes. They are up.
What about down in DC, Suzanne?
We just have scarecrows roaming the streets.
Ah,
It's an everyday occurrence here.
Yeah. Those are just the people hanging around on Capitol Hill, you mean?
Yes.
All right, I'm sorry, guys. I am just not having any luck.
That's all right. We'll just do it via the phone.
All right, thanks.
All right.
so the audio for Dana is coming through your phone?
Yes.
Yeah. Dana, can you hear me okay at this volume?
Yeah, I can hear you. This is John, right?
Right. Yep.
Yeah.
Okay.
And Suzanne is on the Zoom meeting, Dana.
Okay.
And Dana, do you have the deck electronically?
I do.
Okay.
Well, I have what Judy had sent me that you had sent to her.
Yes. Okay. Perfect.
Yeah.
Okay. You're up.
Okay. Well, good morning, everybody. Great to see you again. I'll ask you to turn to page 2 of the deck, just to kind of give you an overview of my presentation this morning. I have within the deck detailed reports for all 4 portfolios. I will make the majority of my comments just on the first one, which happens to be the scholarship fund. All of the portfolios are now identical in composition. So and that was true as of the very end of the second quarter. Performance is nearly identical. You'll see slight differences from quarter to quarter simply because they don't all rebalance at precisely the same time. But in the context of the composition of the portfolio, the models are identically weighted. So I'll make all of my specific portfolio comments on just the first one happens to be scholarship. And then if there are any questions, we can go through the additional pages. But then after that, I'll jump into the market review, and we should have plenty of time for any questions that you have. As always, interrupt me as we go. Any specific time constraint this morning, Judy? Okay.
Great.
So with that, if I can turn you to page 4, and this is specific again to the scholarship fund. You can see the name in the upper left below the bold print. And if I direct you to the right side of the page, to that pie chart, color-coded, as you will recall, blue and purple are our equity holdings, gold, yellow is fixed income. So if you look at that pie chart, you can pretty quickly see this is a roughly 75% equity, 25% fixed income portfolio. Highly diversified. Everything is in compliance with your investment policy. If we look at the more specific line items to the right of that pie chart, you will see your single largest holding within equities is your large cap core concentration at just over 53%. That is the S&P 500. We're getting that exposure through an exchange-traded fund. Again, as is the desire of your investment policy, all of these holdings are, without exception, are passive ETF exposure to the broad indices for the asset classes that they represent. Right below that, within our large cap equity space, you'll see an allocation to large value dividends. Specifically, that is the Russell 1000 Value Index. And that represents a tactical allocation. This was a decision we made at our last meeting to align the portfolio to TD's current thinking tactically, where we have a slight overweight to large value stocks. And that has benefited the portfolio thus far. Below that, you'll see our SMID cap exposure at just under 5%. International below that at just under 5% is the MSCI EFA index. That's Europe, Australia, and Far East. That's been our most challenging holding to date in this environment, and I'll show you the detail in a few pages. And then within fixed income, at a high level, the fixed income portfolio is a 70% U.S. government, 30% corporate bond allocation to fixed income. And then within that, you can see the stratification. We've got a modest allocation to high yield. What you see there as bank loan is in the below investment grade space. We differentiate between bank loan and high yield. You can think of them as high yield bonds. They're all below investment grade. The main difference there is bank loans are floating rate instruments and high yield are all fixed rate instruments. And it's nice to have that diversification. That bank loan product is the only holding in our portfolio that actually had a positive return in the third quarter. Fixed income, I'll remind you, bond prices move inversely to interest rates. When interest rates rise, bond prices go down. So the benefit of having some floating rate exposure is you don't have that fixed rate duration associated with them. So they actually benefit in a rising rate environment. A modest allocation consistent with TD's current tactical view. Those are certainly not risk-free assets by virtue of the lower credit quality, but they have performed well in this environment. And then below that, you see the bulk of your fixed income is intermediate bonds between 3 U.S. Treasury ETFs, each one representing a different point on the yield curve. So we have a 1 to 3 year ETF, a 3 to 7, and a 7 to 10. And then the investment grade corporate bond exposure is with 1 corporate bond ETF. And I'll show you that detail in a few pages. And then cash, you'll notice at just over 4.5% is a couple percent higher than what our target would normally be. I have been letting cash accumulate in the income bucket specifically because it's been the best performing asset class this year. This has helped us. This is not a long-term view. You'll see that rebalance back to 2% over the course of this quarter. Okay? while still just kind of on the overall portfolio mix, I'll just point out for you, because I think it'll be helpful when we look at the performance report. Relative to your investment policy, just a couple of highlights here. Your 5% international exposure is below your 10% target in your IPS. That has helped us. International has been the most challenging component of the equity markets, not that any of them have been immune from the bear market that we're in. We have no exposure to emerging markets relative to the 5% target in your IPS. That has also been beneficial. We sold, when we rebalanced back in June, we sold the REIT exposure that was in 3 of the portfolios when we aligned them all. And that's versus 5% in the IPS. That turned out to be just, better lucky than good timing in the third quarter. High yield at 2% is above the 0% target weighting in your IPS, but your IPS does allow for high yield. We're not offsides there. We're just a little bit above the target. And then on the fixed income side, the 17% government exposure is a little bit above your 15% target in your IPS, and the investment grade at 6% is below the 10% in your IPS. So, it's painful for me to sit in front of clients and show negative returns. It is nice to be able to say that all of the tactical weightings in your portfolio have benefited performance. Not in a way that's probably going to make you want to give me a high five, but nonetheless, at the margins, it's been helpful, certainly help offset the relatively low fees that you're paying on the account, which is 20 basis points. A highlight of performance you will see in the middle of this page on the left-hand side, and I'll show you more detail in just a second, but you've got Inception on top, and this is relative to TD's default benchmark, which is 75-25, but on the equity side, it's 60% S&P 500, 15% MSCI EAFE. And then below that, you see year-to-date at just under minus 21% versus, call it 21.6 for the benchmark, and then quarter-to-date, about 60 basis points better than the benchmark at minus 4.71, and I'll show you more detail on that in a second. In preview, I am not recommending any changes to the allocation to the portfolio at this time. The only thing you'll notice between now and the end of the quarter is just bringing cash back to target. Just lastly, while we're on this page, I'll point out to you year-to-date. I was just looking at what your year-to-date distributions have been from the portfolios. Really modest. When we built these portfolios initially, we had several conversations around what should the cash target be relative to your distributions, and we concluded that the 2% default weighting in cash was never going to leave you in a position, or wouldn't be expect to leave you in a position where we'd have to sell any assets to make any distributions. That very much remains the case, and we are also now, for the first time really since the mid-2000s, in an environment where cash is providing a meaningful return. The Fed funds rate right now is 3.25. We haven't been at these levels since mid-2000s, so that's a good thing. With that, just to take you through some detail on performance, let me ask you to turn to page 6. And what this is showing you on the left-hand side is several different periods, the third quarter, so the period ending 9/30/22 on the top, and then you see the past 4 quarters, and then year-to-date below that. If I can direct you to the top of the page, the number we just reviewed, minus 4.71% in the third quarter of 2022 versus, again, that 5.34% benchmark performance. And then right below that, you see it says COP IPS. That's your IPS target weightings. So all of the variances that I just went through explain the differences between really that 5.83% and your 4.71. If we were identically weighted to your IPS, those two figures should pretty closely match absent your fees. Meaningfully better in the third quarter than both of those benchmarks. Where our allocation benefited relative to the benchmarks you see here is the underweight to international helped against both of those benchmarks. Our SMID holdings, small and mid-cap stocks, helped relative to the TD benchmark, which has no SMID exposure. And then the high yield exposure, as I said, was best performing on the fixed income side, so that provided relative outperformance to both those indices. The cash position helped. Cash has been about the best performing asset class year to date. And then lastly, I meant to mention earlier on the previous page, the duration of your bond portfolio, and you can think of that as an approximation of the average maturity, is about a year shorter than the Barclays aggregate bond index. And going back to my comment where, you know, bond prices move inversely to interest rates, that's one variable. The other is maturity. The longer maturity a bond, the more sensitive it is to changes in interest rates. So that slightly shorter duration profile has benefited. And then I know there's a lot of data on this page. I'll just take you down to the year-to-date column, or the year-to-date row, if you will, about 5 rows down. Same theme, just under negative 21% for the scholarship portfolio, and essentially all of them, versus the 2 benchmarks you see there. All of the points that I just made with regards to portfolio composition apply, with the exception of value stocks in the third quarter. We're pretty much in line with the overall market, but year-to-date value stocks have done better than the S&P 500, so that has helped relative to those 2 benchmarks. And then just while I'm on the performance theme, if I can turn you to page, it should be page 8, 2 pages ahead. This is showing you the specific portfolio composition, again, identical for all 4 portfolios. So if you look at the far left, you see the name of each of the products, each of the ETFs that you're in. And then you can see the allocation in the second column, everything similar to what I showed you on the summary page. You see the asset class and the style that it's in. And then on the far right, this is performance just for the third quarter. Okay, couple of points there. If you look at the top row in the far right, minus 4.9%, that was the S&P 500. Right below that, you see the Russell 1000 Value Index, 5.3, essentially the same for the quarter, but again, year to date, a big difference. Right below that, International, minus 10. That's been the most challenged holding in the portfolio. On a like currency basis, Europe isn't really doing that much worse than the U.S. However, we're U.S. dollar investors, and so foreign assets get translated into dollars, and the dollar has been tremendously strong this year. So when you translate foreign currencies back into the dollars, you don't get as much as you would have had in a weaker dollar environment. So it's not so much that those markets are doing significantly worse than the U.S., it's just when we translate them back into dollars, the strong dollar has been an impediment there. That said, one of the reasons we like the diversification of international holdings, it provides you a little bit of a hedge against dollar depreciation. Fourth line down, you see the bank loan product that I mentioned was the one positive total return in the third quarter, just under 3%. Really modest holding there. You know, it's going to incrementally benefit us at the margin. I will tell you as to where we stand with respect to how the economy is doing. That's really probably that and your high yield holding, which is second from the bottom. Again, 1% allocation. You could think of as probably the riskiest holdings in the portfolio simply because they're the lowest credit quality companies in the portfolio. What we haven't seen dramatically yet in this environment is when I told you that bond prices move inversely to interest rates, that is true, and that is the predominant factor in bond returns. However, the other factor is spread widening. So by spread widening, I mean the spread that investors demand on a corporate bond over a U.S. Treasury security. So in other words, if the U.S. government can borrow for 10 years at 4%, Coca-Cola can't borrow at 4% in most environments. Investors are going to demand some spread over treasuries, and that spread can change. And investment-grade corporate bond spreads have widened from roughly 50 basis points to 100 basis points over the course of the year. And the part of the bond market that is most vulnerable to spread widening is high yield because it's the riskiest. So those products have served the portfolio well, modestly sized. So, you know, we're not swinging for the fences with any risk there. I'm very happy with the performance, but you know, it also happens to be the riskiest part of the portfolio. And then just lastly on this page, in the concept of fixed income duration, if you look 4 rows up from the bottom on the far right, you see negative 6.01, and then the 2 rows above that, those are your 3 intermediate bond holdings. And you'll notice that that performance is nearly directly related to this concept of duration, right? So the 3 to 7 year Treasury at minus 3.8% did better than the 7 to 10 year Treasury. There's no credit risk in those portfolios. It's just that the longer maturity bonds are more sensitive to changes in interest rates. That was all the prepared comments I wanted to make on the specific portfolios before going into the economic update, but happy to answer any additional questions if you have them.
Questions, Peter?
Yeah. When are we going to be able to get the front page of your report, a consolidated sheet?
Yeah, so subsequent to our last meeting, I thought the takeaway there was, Judy, you were putting that together based on the information that you were getting.
Yeah, but we'd like you to do it.
You'd like us to do it.
Yeah.
Judy, if you will send me what you're doing,
Yep.
right? As long as my compliance folks are okay with it. You send that to me, okay?
I would.
It will give us a
Hey, John?
chance, rather than
John,
having to go through.
Hold on a second. Peter's talking. Peter, would you get close to the mic?
Rather than having to go through the whole thing, John, this would give us a cover sheet that would give us a snapshot of everything combined.
If my compliance folks will let me do it, it
What's
will
it
be
got to do
done.
with compliance?
Peter, I live in one of the most highly regulated industries that exists. We are currently dealing with new guidance from FINRA and the SEC specific to performance reporting. And JP Morgan just got fined millions of dollars for violating certain types of regulations within this business. And we have to stay on the right side of that. It's 2022, the regulations get amped up every single year, and I wish I could simplify the world for you, but I can't, and I just have to live within those guidelines, that's all.
John, can you folks hear me okay?
Yeah.
Yes?
Yep.
Yeah, okay. John, and I happen to be in a meeting with, it's John Thompson, right, in your Operation Wealth?
Ken Thompson, I think you must be referring to.
Yeah, Ken, I'm sorry. So, to make a long story short, I mentioned to him Peter's and all of our concern with how can we get some consolidated reporting, and he's taken it away, and maybe you can have a conversation with him at some point. He thinks maybe there's something he can look at that help you along on this.
Sounds great.
Great.
Okay. So let's go back to you, Peter.
Okay, and just for Peter and Tom, Ken is in the wealth area of the bank, who handles a lot of the back office, the operations, the administration. So he might be able to help us.
Okay.
Gentlemen, I will follow up with Ken and see what that, how that discussion went and what promises he was able to make and see what we can do there.
I'll send a copy of my cover sheet to both you and John, Suzanne, so that you both have it.
That would be wonderful, because Ken runs our shared services division and handles all that. John was mentioning the changes in the SEC rules as far as, our compliance department is brutal. Every single piece of paper that we show the client has to be provided through. Every email that we send out is reviewed, and TD in particular is even more careful than other entities for whom I worked. So we are under intense scrutiny when it comes to that, but we are happy to explore all avenues to make this as easy as possible for you.
That would be great, Suzanne. I know we belabored this point with you, but I think part of this comes from that, we all have accounts at different other financial institutions, and we get consolidated, top page summaries of every monthly statement we get. So I assume all these financial institutions are subject to the same FINRA reporting.
Do you mean specific to the trust funds?
Not the trust funds of the city, but our personal accounts, our investment accounts. So I'm not saying, I know what the FINRA requirements are, but that's what kind of drives this equation. We're lazy and we open our things and we look at that first page before we start playing around behind, and it's a quick snapshot of where things stand at the end of that reporting period. That's all. So let's move on from that point, however, and thank you for both of you for looking into that. Any question on John's comments or performance? Any comments, Dana, or questions?
No, John, I think you did a great job going through it, and not much to say.
Yeah. Okay.
Would you like me to take you through the economic update in the back?
Yes, I
Yep.
would.
Okay.
We're kind of more interested in that.
Yeah, so page 33. And let me give Dana a few seconds to scan down. Yep.
Yeah, I'm there.
Okay. So page 33 summarizes your major fixed income and equity indices over several time periods. Fixed income is on top, equities is in the middle. And I'll direct you to the year-to-date column on this particular page. And one thing, as you scan down that year-to-date column, you will see quite clearly there has literally been no place to hide this year. This has been the most challenging start to a year easily in 40 years. Deutsche Bank, and I did not fact check this, but Deutsche Bank claims it was the most difficult start to a year for fixed income since 1788. And part of that is it's not, we don't need to get into our ages, but I think we all, on some level, remember the late 70s, early 80s, right, where, Fed funds got north of 20%. So it's not that we haven't seen higher rate environments before. In fact, in our lifetimes, it's been more normal to see much higher rates, including higher than where we are right now. What's been unique about this time period is, one, the speed with which the Fed has increased rates. It is now October of 2022. Fed funds are at 3.25. It wasn't that long ago when the Fed's own forecast was for there to be no increases in interest rates until 2024, right? So it's, nobody has a crystal ball, but it's always interesting that even the body that controls the short-term interest rate, their own forecasts aren't even remotely accurate. But what's been so brutal for anybody in anything like a balanced portfolio in this environment is typically bonds will act as a shock absorber of sorts when equity markets are going down. And obviously, as you look at just the first 3 rows on the top of this report, that has not been the case this year. Treasuries, the most conservative part of the fixed income market, down 13%. The U.S. aggregate bond index minus 14.6. This is year to date through September. And then corporate bonds, where I told you you've got the addition of some spread risk, almost 19%. And so just nowhere to hide. Muni bonds, you'll notice, second from the bottom of the fixed income section, best, and that has as much to do with Muni bonds tend to be shorter duration by virtue of the fact that they are issued with very high coupons, so that has the mathematical impact of giving them a shorter duration profile from the other indices. They're also less liquid. You just don't see as much selling in the muni space as you do in other parts of the market, and that has cushioned it to an extent. High yield at the very bottom of the fixed income component has actually held up quite well. And then if you look at the one column to the left, 3 months, consistent with what we just looked at in our own portfolio, it was the best performing fixed income asset class in the third quarter. Again, also the most vulnerable to spread widening, depending on what the economy does here. And then down below in the equity section, just a couple points here, which is if you look 4 rows down, 3 and 4 rows down, that's comparing U.S. large cap growth to value. What was the most expensive and best performing part of the market, U.S. large cap growth, think the NASDAQ index, has suffered the most in this bear market relative to U.S. cap large value. That's represented by the Russell 1000 Value Index, which we hold. The Dow, which is a less diversified value index, has done a little bit better than that. Interestingly, on one hand, the dividends that value style stocks pay has benefited them in this environment, right? All else being equal, if the whole market's down 15%, but you own stocks that pay a 3% dividend over the course of 12 months, you'd expect to only be down 12%. So that has been a cushion for value style stocks. At the same time, now that interest rates are north of 4%, those dividends aren't necessarily as attractive as they might be in a low rate environment. So it kind of works both ways. Down below that, international, just to show you kind of my point, international markets really haven't done markedly worse than U.S., but in any given quarter, the swings in the dollar have impacted them. And then lastly on this page, not that negative returns are ever comforting, but in terms of the composition of your portfolio specifically, don't turn back. I just want to get the number right. The scholarship account was down 20.96% net of fees year to date, and that's a 75-25 portfolio. A 60-40 portfolio only did 75 basis points better. So again, your cash allocation, your allocation to value stocks, the high yield, on a relative basis has benefited you. If you turn to page 34, this is the periodic table. And each column is a year. So on the far right, you see calendar year to date through 9/30/22. And what this one's doing is it's showing you all the asset classes that we've looked at and just ranking them by returns. You know that if you do what I do for work, it's been a challenging year when the best asset class is down 12% year to date. You can follow your eyes across that top line from right to left, and you won't see another year going back to 2012 where on an annual basis we were negative. Gives you a sense as to how strong the markets were over the last decade. Value stocks, again, 3 columns down, has benefited us. And then at the very bottom, just pointing out what we've talked about earlier, but you can see it here, emerging markets, REITs, and growth style stocks, all of which we are underweight, have been the worst performers this year. So I am happy with the tactical decisions that we've made. If you turn to page 35, it's a similar chart, except it's specific to equities. And what it does is it takes the sectors of the S&P 500 and breaks them down by performance. The presentation is otherwise the same. Each column is a year. I've told you this before, to beat the S&P 500, you just have to predict which sector is going to do better in any given period. And if you just, without even looking at the words on this page, if you just look at the colors and the color yellow specifically, energy has generally been either the best or the worst. It's just impossible to get this right. And more recently, if you look at the 3 best performing sectors this year, even though they're all down with the exception of energy, they were at the bottom of the list last year, right? All the defensive utilities, consumer staples that have done well this year were at the very bottom last year. So it's why both in your investment policy and we as a firm stress diversification. I want you to have exposure to all sources of return. You're never going to see us, have a 50% overweight in any one sector, because this is just unpredictable. And that diversification definitely has helped you this year. Page 36 and 37 gets to TD's specific views. I'll ask you to turn to page 37 just because it gives you a more granular look. At a high level on the fixed income side, interestingly, you'll see we're underweight short-term bonds and a little bit overweight intermediate bonds. This essentially represents your current allocation anyway, but more importantly, in a rising rate environment, why would we be underweight short-term bonds? Because our interest rate forecast is that we have pretty much seen all the rises in interest rates that we're going to see this year, with the exception of the Fed raising the very short end. And I'll show you our forecast in a little bit. So good time to put that cash to work. We're slightly underweight high yield in the fixed income space. You've got that represented in your portfolio today. And then below that in equities, you can see we've got a modest overweight to value, which is represented in your portfolio. And then you see the underweights to international. So again, going back to my earlier comment, no recommended changes to the portfolio today. If you turn to page 38, if we think about the S&P 500, what have earnings done? What is our forecast? This is showing you forecasted earnings per share for the S&P 500 on that top line. You can see if you compare December 2022, that's the third column from the right, to 2021. These are consensus estimates calling for a roughly 8% increase in S&P 500 earnings this year. TD's view is that those will most likely be coming down. We do not think we're out of the woods yet with regards to equity performance. And then, for what it's worth, consensus forecasts have earnings growing roughly 8% for the next couple of years. As a data point, if you look at the bottom row, if these earnings forecasts were to come true and the S&P 500 price held steady, you can see what the PE multiple would be for each of the successive years. The bottom line here is, despite the correction in equities this year, based on these earnings estimates, stocks don't look wildly overvalued. They also don't look screamingly cheap. Okay. Page 39 this is just for reference. We know this. Stocks tend to go up over the long term. This chart nicely highlights many of the challenges that equity markets have faced over the decades, and yet, strong companies do what strong companies do, which is take advantage of whatever the environment provides, adapt and grow over time along with the overall economy. We don't expect this to be any different. Page 40 there's a lot of detail here, but it's a pretty cool chart, so I wanted to include it, something you may choose to look at after the fact. But what this is showing you is 13 bear markets going back to the Great Depression, and in each of those, how long was the duration of the bear market? And in that middle column on the bottom, what was the macro environment, and then what was the bull market return following it? I got out my microscope and looked at this chart pretty clearly, and my takeaway is, don't look at any one of these periods and try to predict what's going to happen here. There's really no predictability to it. There's also no perfect analog. We have been in periods of rising interest rates with an aggressive Federal Reserve, perhaps a commodity spike thrown in. I specifically identified 1968, 1980, and 2007 as three of those periods, but they were all different in terms of the magnitude of the decrease in the stock market and the duration of the bear market. That said, if you look at the very bottom row of that table where you see the averages, the average bear market's been 41% with a 20-month duration. We're currently at the peak down 23-ish% in the S&P 500, 9 months into this as of September. My main takeaway from this chart is that bull markets last longer than bear markets, and they more than make up for the gain, and you can see that on the bottom there. And we don't expect this environment to be any different. If you turn to page 41, we'll move to fixed income. This is a great graphical depiction of the yield curve. So you're seeing three lines compared there. I'll ask you just to focus on the red one and the blue one. So that's 12/31/21, so not, almost 10 months ago, compared to the end of September, which is the blue line. So you see this dramatic increase in interest rates from an exceptionally low level to a, call it mid-single digits. Again, it's the speed with which we saw this increase that has really surprised markets. You'd have a really hard time finding an economist who predicted the level of inflation that we've seen coming out of the pandemic and the duration of that inflation. And, you know, we really shouldn't be surprised to the extent that the circumstances that led to where we are now, i.e., you know, the COVID pandemic and the unprecedented amount of both monetary and fiscal stimulus, nobody saw this environment before. And I think when folks write books about this down the road and look back at this period, right, the one downside, we have all benefited as consumers from products being made around the world using the lowest cost labor provided, right? It's why it's hard to look at a tag on your clothing and see made in America, right? Maybe designed in America, sold in America, but it was probably made in the Far East somewhere. And so for a couple of decades now, we've seen companies identify the cheapest sources of labor and make their products there. Well, that's great until ships stop shipping and you know, workers are forced to stay home and you can't get goods anymore. And you've seen it in the auto industry. There's I get my shirts at a shop in Portland, Maine. It took 6 months to get a simple shirt in because the buttons didn't exist. You know, the buttons on a shirt, right? 6 months. I mean, just crazy. That's one simple example, but we've all experienced it. So here we are. The main point I want to make on this chart, in addition to the obvious dramatic move in interest rates, is if you look at the middle of the page, and this is just look at the blue line and go up from the 2-year, you know, you see the 2-year Treasury at roughly 4.30, and then look at the 10-year at, in this case, it's a little over 4% now, but at the end of the third quarter, it was just under 4%. The curve's inverted from 2 to 10 years. That is the bond market telling you, absent any supply-demand dynamics, and I don't think too many exist right now. In other words, the Fed's not out there buying bonds as they did during the pandemic. So what this is telling you is the bond market saying, we think the Fed is pretty much done tightening, right? And we think inflation is on the way down, not up. And we have seen inflation stabilize. It's still at a much higher level than the Fed wants, significantly above the Fed target. But the market's pretty much saying, okay, you know, we think it's done. And so that's why, from a fixed income perspective, and you'll see this reflected in our forecast, you should see, once we get into the first quarter of 2023, you should start to see positive returns from fixed income portfolios. And, you know, meaningful, you know, 2, 3, 4% just based on the coupon income. And then lastly, I'll conclude with TD's forecast. So on page 42, a lot of data on this page, but let me try to just give you the highlights. If you look at the top table in the middle of the page, top row, this is TD's forecast for the Fed funds target rate. So that first grouping on the left is 2022. We are in the fourth quarter. Fed funds rate is currently 3.25. We think the Fed will raise that another 100 basis points before the end of the year. Nobody knows if the Fed's going to go 50 or 75 basis points in a couple of weeks when they meet in early November. They had been telegraphing 75 basis points. We'll see. We have finally started to see some slightly dovish comments out of the Fed. And as you go across that row, you'll see we see the Fed getting to 4.5% before they take a pause, and then just go over to the end of 2023, 3.5%. So we think the Fed's going to ease, and that wouldn't be inconsistent with history. You know, the Fed tends to over-tighten, and I don't mean that in the sense that they're making a mistake. It's just that their work, the economy responds on a lag to what the Fed does. So, you know, it's almost like flooring your car and then stepping off the gas, but you're still going faster for a while until you finally start to slow down. So we think the Fed will actually ease by the end of next year. That is probably a little more aggressive than what the Fed is currently saying. We'll see what they update over the next couple of meetings before the end of the year. But then to my point about fixed income returns, if you look at the yield curve forecast below that, and you can pick any of those points, we pretty much think the high in rates is now, you know, between now and the end of the year. And as you go across there, we think the curve will anticipate that Fed easing and come down over the course of 2023. So, you know, this is a forecast. I don't think TD's forecast has been any more accurate than any other major dealer forecasts I've seen. Pretty much everybody missed the magnitude and the timing of the rate increases this year. But here we are, and in terms of, you know, some validity to this forecast, I can tell you that from an economic perspective, the good news is the unemployment rate is still really low. You know, we usually only know in hindsight if the economy actually experienced a recession. That's always a backward-looking data forecast. However, the index of leading economic indicators has been down 9 months in a row. So it does appear, you know, that this tightening is taking hold. And then lastly, at the very bottom row, just our forecast for core CPI, you can see, and I've read this amongst many market participants, even if inflation stops going up, the overall level of inflation isn't going to get down to 2% anytime soon. It would really take falling prices to get there. And that's, of course, the balancing act that the Fed's trying to manage between, you know, keeping us out of a recession and keeping inflation at these levels. This level of inflation is absolutely brutal for the majority of Americans who, you know, a very high percentage of Americans don't own stocks. They don't own their own homes. This asset inflation has not benefited them all. They spend most of their money on groceries and fuel, and it's been absolutely punishing to them. So this is extremely important to fix, and it's why the Fed is willing to tolerate some pain in the capital markets to get inflation back down to these levels. But you'll see it is going to take some time. That was all my prepared comments. I thank you very much for the time. And
What's going to happen when the federal debt keeps increasing and interest rates increasing?
yeah, it's happening now.
Yeah.
It's happening now. Yeah, it's estimated that the interest cost on the debt alone on an annual basis is, you know, it rounds up to $1 trillion a year, right, from a very low level. Yep. So, as a betting man, you might conclude that that's another really good reason why the Fed wants to get inflation back down, because this level of rates is really, really difficult. Yep. And what it tends to mean, you know, the U.S. tends to lag, right? Europe has been around a little bit longer than the United States, so we can look at the economic history of Europe as perhaps a precursor of what's going on here. Peter, it tends to mean slower growth over the long term.
It's more of a reason why we need a balanced budget.
Amen.
Bring back Warren Rudman.
Warren Rudman and Paul Tsongas, right? Any questions or comments, Dana?
No, this was pretty thorough. You know, talk about summary report. This was a good one. You had a lot of good information in there, particularly like the periodic asset class tables.
Yep.
It was helpful.
Good. Very glad to hear that.
I
Thank you,
agree.
Dana.
John, could you briefly go over the two little reports that you did on the comparisons?
Yes, thank you for the reminder, Judy. And this is an email that was shared with the trustees.
Yes, they have it as well.
Yeah, so in response to your queries with regards to one, providing, you had just asked for the current sustainability ratings for all the holdings in the portfolio. So depending on how you have it printed, you can see that. I put the as-of dates on there. This data is straight off of Morningstar's website. So for each of the holdings, most of them are 3. One of them, I think your mid-cap fund is 2. You know, that makes sense in the context of, if you think of the mid and small cap stocks, you get a lot of energy sector holdings in that space, whereas the energy sector is only like 3% of the S&P 500, so that's most likely why they score lower there. But most of your ETFs are 3s. Keep in mind, none of your ETFs are specifically targeted towards any form of ESG rating, so this is just the ratings as they exist. And then Morningstar, as of when I looked at this, which was just a couple of weeks ago, doesn't rate the 2 high yield holdings, although they'd likely be, you know, my guess would be, based on the composition of those companies, probably 2. And then I put right below that, don't ask me to explain this beyond the verbiage that Morningstar provides, but you know, what is their sustainability rating? It's a measure of how well, and this is a quote from their website, how well the portfolio holdings are managing their ESG risk relative to the global category peer group. So in essence, we're comparing the broad indices to a peer group that would include funds that are specifically targeting ESG ratings, right? So it's a relative rating. So those are there for your reference. And then lastly, there was, Judy had provided some peer analysis that I think you'd been provided previously, specifically looking at the Maine Community Foundation and the New Hampshire Charitable Foundation. So I provided you their detailed, portfolio holdings, along with my editorial comment, if you will, that I do not think they're something that you really would choose to spend much time looking at. These are not peers by any sense, to the extent that these are $600 million funds or higher. More importantly, I'll also point out that the timing of their issuance is such that, I think one of them was the second quarter, one of them was the first quarter. So there's a timing mismatch. There's also a mismatch in terms of net of fees, gross of fees. But most importantly, 40% of those funds are in hedge funds and private equity, which are not represented in any capacity in your portfolio. Your IPS prohibits it. And perhaps more importantly, private equity and hedge fund investments aren't marked to market visibly the way the public markets are. They're essentially marked to model. And so they're not nearly as price sensitive to changes. So it's really, not a good peer comparison, but you asked for the data, so I wanted to give it to you. I think that was it on that. Just one final point on that. In those reports, the one thing that I found interesting is you got to dig for it, but they do show you their performance for U.S. large cap stocks, for example. And I can't remember which one it was, but they were underperforming the broad indices, the S&P 500, for example. So that would be the one part of those reports where you could say, okay, we're in the S&P 500. How's that doing? How did their large cap stocks do, or their mid cap stocks? And I can't remember if it was Maine or New Hampshire, but their large cap stocks were underperforming the S&P 500. So, that might be the one useful takeaway. Thank you for the reminder, Judy.
You're welcome.
Other questions of John? Dana?
No, I'm good, thank you.
Peter?
No, fine.
Anything you want to add, Suzanne?
No, I think John pretty much covered it.
Yeah, thoroughly. I'm good as well, so
Thank you for your time.
well done.
Great to see you. Yep.
Nice to see. I'll
Just
send
send
that
me a
to you.
follow-up?
I
Okay.
will.
Take care, Dana. See you, Suzanne.
All right, thank you. Thank you,
my
John.
pleasure.
Thank you, Suzanne.
Bye-bye, Suzanne.
Wishing you a great rest of your fall.
See you too.
Mild, healthy winter.
Holidays coming up.
Thanks for your time.
See you, Jim.
Safe travels. All right. We have nothing further on our agenda, and there's nobody from the public, so unless there's any new business, I will,
We adjourn.
okay. Do I hear a second?
Second?
I have to take a roll call. All in favor? Peter?
Yes.
Dana?
Yes.
And the chair votes yes. Okay.
All right.